Thanks for downloading this episode of the Resilient Advisor Podcast. My name is Jay Coulter, and joining me for this interview is Sean Brown, the CEO of YCharts. If you are not familiar with YCharts, they are the leading investment research, data, and analytics firm serving wealth managers and institutional investors. We are going to go deep on a topic that, in my experience, advisors find ambiguous at times: model portfolios. Sean, thanks for taking some time with us today.
Jay, thank you for having me on the show.
All right, today's model portfolios are not your home office model buy list created by the investment banking team 15 years ago to go out and sell investment banking deals. They've changed. Tell us, what trends are you seeing with model portfolios today?
Well, let me start out with kind of the macro context that we're seeing, because we spend 100% of our day talking to either wealth advisors or asset managers. And the big things we're seeing are best captured in a couple of studies I saw recently, where one was from Ignite's research, which showed that one of the top three reasons that clients leave their advisor is portfolio performance. And if you pair that with the Michael Kitz's study that came out a little bit ago, he said advisors are spending 10% of their time on investment management. So there's a disconnect there that says one of the biggest risk points for you, you're not spending much time on. And you got two choices there. You either spend more time, and we're not talking to advisors who have a whole lot of time on their hands, or you do better investment management. And so that's the macro context that we're seeing, just an absolute influx of discussions, chaos going on around model portfolios right now.
Yeah, the term really needs some defining and definitions specific to the different markets. Let's talk about it for the independents, and then let's talk about it for the folks that are still in the wirehouses.
Yeah, and I would reiterate the need for terms. This is not too dissimilar from the stuff when Alexa skills or mobile apps or robo. It's like everybody gets excited about it, but not that many people actually know the details of the concept. We are just seeing with the breakaways, they're saying, wow, this looks like a fantastic concept to help me perform better investment management and research, but where do I start? Mm-hmm. And there is so much, like with all these technologies, there's excitement, which leads to chaos, which then leads to a shakeout, in my impression, which eventually leads to rationality and objective behavior. I think we're in kind of the chaos stage right now.
Well, so let's put some application to this. Where do you start? You're an independent advisor. Say you've broken away in the last couple of years. You have a book of business that has 200 different mutual funds in it, 150 different individual stock positions. Maybe you have a ETF model, and you need to streamline the business with model portfolios. What do you do?
Well, I think you need to have a thesis of your own. And that thesis needs to be around how you pair different portfolio concepts to different clients. And once you have a thesis, you can better search for models. And, there's all kinds of model marketplaces opening up. You've seen them here. There's a press release every couple weeks about the best model marketplace. Then the journey begins, right? And the concept is build once, through experts, build once, and then it can be used multiple times. Mm-hmm. But there's this, we're seeing, and I don't know if you see the same thing, we're seeing this common misconception that to sign up for a model means the same thing as being wedded to a TAMP, which is, well, once I subscribe to that model, my parameters and my ability to customize and make it unique is zero. And what we're actually seeing advisors doing is they're saying, first, the journey to get to the right model is difficult. But they're saying, once I've got that model, the reality of the situation is my clients may have held away assets. They may have particular investment criteria of their own, which means the model is a template, but then they are able to veer from that and manage that and rebalance that on their own.
Well, I tell you, Sean, in my coaching practice, I find that to actually be one of the bigger challenges. An advisor will adopt a couple of models, and then the market moves against the model a little bit, and they'll start cherry-picking stocks for the model. And then it becomes a disaster within a couple of quarters. How
Yeah.
does the advisor who's starting down that journey now keep themselves from doing that, as opposed to the one-off situations that you're talking about?
Oh, it's so analogous. You had on the CEO of Riskalyze a little bit ago, Aaron, and Aaron was talking about the fighting human behavior, and human behavior says, despite what I think I've agreed to, I'm going to react emotionally sometimes, and I may stray. I think one of the biggest ways to stay disciplined about these is for the advisor to write down what their approach is going to be to things like rebalancing, to things like customizing a model portfolio. Write down the discipline that they intend to stick to and communicate that discipline and then stick to the discipline. I think that's the hardest part is all rules are fungible if they're not written down and you don't commit to stick to them.
Let's talk about that from a best practices standpoint. Do you advocate for investment policy statements as it relates to the models and then for each individual client?
I think the better and more clear and the more documented communication is, the more you're staying aligned with your client. It's really, really difficult to say, hey, Mr. Smith, you remember that discussion we had back in October of 2016 where I told you here's how I'd approach it. And Mr. Smith says, no, I don't. In fact, I recall it differently. So to answer your question succinctly, I believe if you believe in something strongly, you should be able to put it succinctly to paper. You should be able to hand it across the table, and you should be able to stick to it.
Okay. So speaking of influence, if you're an advisor, you're looking to service providers to help you build out your models and you're working with a wholesaler, there's going to be that inherent bias. How do you get through the noise of identifying, what's real advice versus the service providers that are just looking out for themselves?
Yeah, Jay, you've hit on the fundamental challenge, right? If you layer in words like fiduciary responsibility, whether you view that from a moral standpoint or a regulatory standpoint, you have an obligation to understand the recommendations you're making to a client. And this is where we see a huge opportunity in the space is, hey, if the models that you are interested in are offered by asset managers, do not be surprised when those models consist of the specific funds or ETFs that are run by those asset managers. If you subscribe to a marketplace that has limitations on the scope of offerings that they have, make sure you understand those. The other thing is understand the funds flow that you're seeing in whatever. What are the value adds that each step of this disaggregated model might be looking for? How is that guy who's marketing the fund making money? How is the person who is putting it out in a marketplace? How is the asset manager making money? Make sure you understand those things. And this is the opportunity we've seen at my business is get yourself in a position where you can compare apples to apples. And the only way you can do that is through data and tools and spending a little time researching.
I want to go deep on what your offering is and how advisors could leverage YCharts to do that. But could we start with the model marketplace as it stands today? I mean, to me, as a coach and consultant, it looks like the wild, wild west. What are your thoughts, and how do you think these marketplaces will make life easier for advisors if they find the right one, and how do they do it?
Yeah, where we're headed, I'm crystal clear. It's going to solve the goal. The intended goal is to make life easier, right? Better investment decisions more efficiently. Right now, it's making life harder. Like when robo platforms came out, which robo platform should I go to? How do I compare one robo platform to another? Right now, there's just this proliferation of marketplaces, models. If you said there are north of 10,000 model options out there right now. How is an advisor supposed to say, I recommend, I narrowed my list to 5 models that I think are right for you, Mr. Smith, and here's the one I most recommend? That's where we're going to be, is that's going to be an efficient process. Where we are now is in this chaos stage I mentioned earlier, where it's all got to shake out a little bit. And we have to have a little time pass so we can see which of these model marketplaces and which of these model creators are actually adding value. They will survive the test of time, which brings more assets their way.
All right, so let's put some application to that. So how can somebody vet that process given the way the marketplace is today, and how can YCharts help them do it?
The problem, the opportunity we can't yet solve is to tell you which marketplace and which model within the marketplace is right for you. As one answer to the question, our guidance to people is to find the right marketplace, do your homework, understand fees, and understand how fees are shared in that value chain. Do that, and that'll help you narrow your list and understand where biases occur in there. Where we help players is if you've narrowed your list down to a few models, 5, 10 models, we help you compare apples to apples on those models. And to, because at the end of the day, what's a model? A model, the atomic elements of a model are funds, ETFs, stocks, and other tradable securities, right? We've built a business based on helping people compare the different performance characteristics, the different risk characteristics, the different exposures to those atomic elements. So we help you when you come to us and you say, I have 2 or 3 or 5 models I want to compare. Right now, your only option as an advisor is to look at a couple tear sheets and try to make sense of those. You know what? The advancement's been the tear sheets aren't just paper, now they're laminated. That's the state of the tech. You get laminated tear sheets. What we help you do is take those atomic elements that you're seeing in these models, and we will look at the model itself as a security with performance characteristics, risk characteristics, exposure characteristics, and we will help you see and tweak that model.
God, it makes perfect sense. So when somebody first engages with YCharts to go through that process, I'm assuming there's a data dump into your system, and then there's output. What does that output look like?
So the data dump is right now, take your tear sheet, enter a few of the characteristics in there, call it model from Marketplace 1 that you really loved, and compare it to model Marketplace 2. Where we're heading with that is as the model marketplaces shake out and the models, we will be obviously digitally ingesting those. But right now, that's not where the industry is. So, but once the model is in your system, the output for us looks exactly like the output for an ETF, a mutual fund, or a stock. It is a page with all of the performance characteristics. It's a breakdown of the exposures, the risks, and the prior performance. That's in the system. That's in the database. And then what do you do with that? You want to view performance in a chart? You can do that. You want to do a comparables table. You want to pull up, hey, now that I've compared this model, what is my true exposure to China or LATAM or some specific item? And you can look at them, you can compare them. And the big thing that we love to talk to advisors about, you can document your decision-making process by saying, here's why I went from 10,000 options down to 6, which led to 1, which gives peace of mind, and it also allows them to do their duty, which is to make a good recommendation.
And for a softball question, could you contrast that with the Bloomberg output for somebody that's trying to compare models?
Take away just about every adjective of what I said there and enter code line commands and try to look side by side and see what you come up with. And I would say we have the good fortune of creating our technology in the last 10 years and anticipating some of these items. So one of the big things we tried to do up front is to have a really easy to use user interface. And the flexibility when you created a chart or a comparables table or whatever, we're using browsers, we're allowing you to double click, we're allowing you to use natural language. And you just maybe don't need to be quite the rocket science to use this stuff.
Yeah, especially for today's wealth manager. So it was a softball question. Because I've had several clients get frustrated with the Bloomberg experience, and I know they're using YCharts, and it's just a much easier application to use. But let's go a little bit deeper if you're doing individual stocks, because I'm finding the model marketplace is attractive for people who've been running stock models for the past 10, maybe even 15 years. They did it through the last crisis, but now they would like to add some enterprise value to their practice. They don't want to be in charge. Having a rules-based process helps that. What are some ways that they can leverage your system to get that done?
Well, we're seeing people, the way they're leveraging individual stocks is either in the kind of the core satellite model or as sleeves. And basically most are saying that's the way I'm going to be able to help you explore alpha and outperformance. And it's usually a really enjoyable exercise between them and their clients where they're saying, hey, I've got this model, but I've allowed some leeway for 5 to 10% of that model to talk about things that you're excited about that I, as your advisor, think would be prudent investments. And that's not cryptocurrency, and things like that. It's, hey, you really have Mr. Client shared with the advisor, hey, we really have a premise or thesis about a certain sector of the market or a certain geography. Why don't we, through a sleeve or through some other approach, why don't we take this model in a direction specific to you? And if an advisor is hearing the same thesis from a number of clients, it makes it for a very easy model to, create a sleeve and 10%, 5%, 7% into that equity sleeve.
Yeah. And I tell you, so for advisors who are curious about the YChart offering, they offer a 7-day free trial. It's so much fun. Block off some time and do a deep dive on it. It's a great platform. Sean, I'd love to wrap up with a question that I'm finding more and more when I work with the folks delivering portfolios to folks is this challenge that comes with rebalancing. The academic research is irrefutable. Rebalancing matters, but execution is the challenge. What advice do you have?
I'm going to sound like a broken record. Write it down. Write down your approach to rebalancing, because if you rebalance too quickly, you're going to miss some gains. And if you rebalance too late, you're going to face some other consequences. What is your rebalancing philosophy? Write it down. And it's not something you do every day. It's something you do monthly, quarterly, or biannually. And if you can communicate that to your customer and say, listen, we're going to tilt in a direction based on some outperformance. That's the way it's going to play out. And we're going to seek to revert back to our desired approach every quarter. That's where the advisor is able to have a very personalized discussion sometimes with that client and say, listen, this isn't a TAMP where it's done for you and the rules are what they are. I may know for particular tax-related reasons or interest reasons, we may want to veer off of that rebalancing approach, but do it with discipline. Don't do it with emotion.
It's funny, you say that you sound like a broken record, and to me, that's what makes for a sound strategy. I tell advisors, if you're excited about your investment approach and philosophy, you're not headed down the right path for your clients. Sean, I really appreciate you coming on the podcast. This has been really, really, really great information. How could listeners find out more about YCharts?
Okay, I have two things I'd say. Number one, we're at YCharts.com, the letter Y, wordcharts.com. Come visit us there. I wanted to maybe offer your listeners a special promotion if they're new to YCharts. Certainly come and have a 7-day free trial. But I'd offer for anybody that references this podcast as a new user, I'm happy to offer 20% off. So come visit us.
Very generous of you. Sean, thanks so much for coming on the podcast.
Thank you, Jay. Great to be here.